It is March 25th and it's a Sunday, actually Monday, very early in the morning, 1:30 a.m. right now, making this video really late. I did not make one on Friday. I didn't get to record that $1,000 loss that I suffered. So after I take you through what happened in the account, we're going to talk about the three main types of positions you can have out there in your account and some of the important things about each one of them. All right. So let's jump in. So this is the weekly performance of the account. It is only up a few $100, but it has lost the ground over the last Friday. The main reasons are outlined right here on the side. I have already switched it to the dollar amounts that have been gained or lost based on position, and as you can see, Apple has been the biggest contributor to some losses. It got sold off a bit after it announced news about streaming services. They're going to talk about it more today, later today, so I'm going to find out exactly what's in the bag for Apple later today. C-SPAN was sold off, the Russian market was sold off, Wheaton Precious Metals was a winner. Other notable degenerates are the uranium sector, energy fuels, and chemical, as well as the uranium sector ETF were big losers for me today. So that's all good and gravy. I have a bunch of dividends coming in at around $100-ish pretty soon at the end of this month. I'm not going to go through them. I'm just going to show you a quick overview of the account. Here we are sitting at Apple's the biggest holding by far. And then we have Wheaton Precious Metals URAL ETF. We can sort them by equity. We can sort them by return. Right here. These are some of the biggest positions. All right, and that's about it. That's all you need to know. I don't have many options running. I have chemical. I've sold a put against chemical, so I'll be purchasing 100 more shares, getting right back into the company at $12, a little bit more overpriced than I would have liked. We have energy fuels, put option sales that are going to be expiring on April 18th. And then we have the URA call expiring on April 18th as well. That's it. We're going to get back into our topic of today, which is the three main positions, three different types of positions that you can have in your account, and some of the ins and outs and what's important to know about them. First and foremost, by the way, I've made this amazing background drop for you real quick before the video started, and this is what it looks like. Boom. Oh, I'm hidden. Oh wow, it says trade there in the bottom. I didn't plan this too much. So the first main type is the buy and forget type of investment. Now, what kind of investment is that? Well, number one, it cannot be an individual stock. It has to be some type of an index. Why can't it be an individual stock? Because individual stocks go bankrupt. Pretty much all of them. I don't know of a single stock that was out from the beginning of trading exchanges that's still alive today. If you know one, let me know. But at least one of the oldest one, I think, from in the Dow was GE, and that's not doing too hot right now. But anyway, so you can't invest in a single stock because something goes wrong, the management goes away, new management comes in, and they bankrupt the company, or something goes wrong. They're out of favor. They can't catch up with technology. They get outcompeted. The single stock is not a very good investment for the entirety of your life span. You could get lucky if you catch one in the beginning of the growth period and it does well over the long term, but it's a exception of the rule. Okay, now the next type is the buy and watch. And what is the buy and watch stock? Well, it can be a single stock, it can be an index, it can be a country, it can be a specific economy around the world. It's an investment that you sorry for the shaking here. It's an investment that you buy, but you know that something might go wrong, and so you're in your fingertips. Not it's not on your fingertips, but you're ready to sell at any moment. If your thesis changes depending on the facts changing. By the way, we didn't go over any examples of the buy and forget positions. Those are, like I mentioned, indexes or like global dividend funds, things like that, that no matter what happens with individual single companies or economies around the world, you are fairly well diversified and you're collecting income off of that, as long as you are alive. And if that index goes bust, I mean, that is not a good thing. That's not a world you want to, that's a really pessimistic way to look at things, all right? That means we're in the middle of a nuclear war or a huge asteroid has just hit Earth. So that stuff is buy and forget, okay? Now, what is the buy and watch investment? Well, it can be a country. Like, let's say you buy into China and then you want to watch that because what if China's in things don't go too well in China and they become socialized again and they go back to communist economy, socialism economy, and everything is centrally planned and everything else. So it's going to be, you'd want to sell that. Or if it's a single stock, let's say as cool of a stock as Facebook, but they get hit by a bunch of rules and laws and they get shut down for some reason, because I don't want to speculate why, but they could get shut down. It's just a company, anything can go wrong. And so you want to watch that position and you want to make changes in your investment thesis as the facts change. So you can dump it or you can buy more if you think that it's become even a better bet. So the last type of position you can have is a trade position. Now, a trade position can take many different forms. So I showed you my EXK on the last video, how I was scaling in and out, and that's a trade. I mean, I've identified something like the silver sector having a little boom after every market crash or slash correction. So we're trying to scale in and out into that and then scale out of it, right? So it's a trade idea. It's got a time period. It's very well defined. A lot of trades you may want to manage your risk. So what you can do is you can initiate stop losses, or you can hedge it with something else in the industry or in other industry, or whatever you think is a good hedge. You can have a three-way hedge. You can have a level that you're comfortable entering in, and you can have a level that you want to sell at. You want to have a plan basically for entering and exiting that position. That's what really a trade is. You want to plan the entrance and the exit. You don't want to just buy arbitrarily and then have no plan to of action whenever anything develops, right? So let's say you buy a position at $3 each share, and then it goes down to $2, and what do you do now? You have no plan, so you panic. So it's like, do I buy more? Do I sell my position? So you haven't thought of that ahead of time, and you're going to be suffering some losses because you're unprepared. All right, so that's what a trade is. You can set up the trade right from the beginning. You can offset trades, like maybe you buy option, you buy a put option in one trade and you buy the underlying asset, or reverse. You can buy the underlying asset and sell a call option, or anything that you have plans for, and maybe you have a buy and wait approach to a stock, and you decided to make it into a trade by selling a call option against it, or you can I don't know, go short a stock and then selling a put or something. I don't know. It's up to you to develop that strategy. Make sure that it makes sense. Make sure that depending on what your timeline is and what your plan is, and don't just arbitrarily pick things as the trade is unfolding, right? You want to make sure that you've thought of that ahead of time. Um, Make sure you have your limits. You can set it to sell automatically at a certain price. You can set it to, limit your losses at a certain price. So make sure it's a well thought out trade and not just something you do on a whim. All right, because you're gonna be losing money, a lot of money that way. So be careful. So those are the three main positions that you can have in your account. That they all take many forms. As we discussed, the buy and forget can take many forms. Maybe you can have U.S. bonds as buy and forget. You can have the S&P 500 as buy and forget, but it's very U.S. specific. But still, the U.S. is very internationalized. There's a lot of multinational companies in that index, so you should be fine over the course of your lifetime if you just buy the S&P. You can have a dividend, the globally diversified fund, etc. But it cannot be a single stock. And the buy and wait can also be an index. It can be a country, it can be a localized economy, it can be a specific sector, like let's say tech, for example, or whatever, transportations, the new communication sector, right? So you can have all those, but you have to watch them. If the thesis change, if things change around the world, right? Let's say you buy a commodity index, you definitely have to watch that one. You want to make sure you scale in and out, or you outright sell it if things change according to your plan. And then you have trades, which can take many, many, many different forms. You can just buy an option and wait to expiration and just bet that money and will it be willing to accept the premium loss. You can have all kinds of ideas, and you can pair them. You can have a triangle trade, all hedged off of each other. So make sure you think about it ahead of time before placing it, and they all vary in risk. All these three different positions, they all have different risk tolerance, right? The trading obviously is the highest risk and is the most complicated, most complex. So make sure you really know what you're doing when you're trading the market. Okay, that's about it. I wanted to just shed some light on the different types of positions and make sure I structure them by risk, and shed some light on what you're doing, right? And what kind of actions you're taking to control your risk, and what type of investor you are, and what you're doing to watch, forget, or control your investments and trades and your positions in your portfolio. Let me know what kind of investor you are. I want to know. All right. With that said, peace out.